Now we're going to explore something that to the beginning investor can be a little bit of a complex subject, and that's called selling short.
Mm-hmm.
And what selling short involves, it involves borrowing an asset, selling it, and buying it back later on. Mm-hmm. And that buyback is what determines your profit and loss. Now let's say we have 100 shares of IBM, and IBM is priced at $100 a share. Now what we're going to do is we're going to borrow 100 shares. It doesn't cost us anything to do that except for margin interest. Then we're going to sell those 100 shares at 100. That gives us $10,000.
Right.
Now, let's say IBM is at 100 and goes down to 80.
Mm-hmm.
We then buy 100 shares at 80.
Mm-hmm.
That cost us $8,000.
Correct.
We've borrowed 100 shares.
Mm-hmm.
Now let's return the shares we borrowed.
Mm-hmm.
There's no cost there, and of course there's no cost there.
Right.
You add this up.
Right. Plus $2,000 on our trade.
You made $2,000 on IBM dropping $20. So that's the description of selling short, and that's how you make money in a declining, when the asset price declines from selling short. Now, a lot of people sell short and they don't understand exactly how the process works. I tend to be one of those people that it's vital for me to know how it works.
Right.
This is how it works. You borrow it first, and you're borrowing it from the brokerage firm.
I was going to say, this is kind of seamless, though, isn't it? When you call the broker, he doesn't say, okay, I'm going to lend you these 100 shares.
Absolutely. What happens, it's funny, when if you take delivery of the certificates,
Mm-hmm.
they can't loan it out. But you ask in your brokerage statement, you ask them, do you want delivery of the certificates? Well, then they keep them and loan them out to people.
I see.
And so that's how, if people kept their certificates, short selling wouldn't be possible. But because people domicile the certificates in the accounts, then short selling becomes possible. So, and this is the behind the scenes way it works. All you need to know is IBM went from 100 down to 80. You make $1 for each dollar it drops. That's $20. You had 100 shares. 20 times 100 is 2,000. That's what most people see. Now that's a description of selling short. But and selling short is a way to profit from a decline in an asset price. Now what we're going to look at is another way to profit from a decline in an asset's price, and that is through the use of a put option. Now, a put option gives the buyer the right to sell the stock. So they're going to sell the stock to the grantor of the option at a predetermined price. That is, they're going to put that stock, if you are the seller and I'm the buyer, I am going to put that stock in your hands whether you like it or not.
Okay.
Now, let's take a look at how that's going to work. If the stock is at 50 and you buy a 50 put and the stock falls to 40, I'm the buyer of the option.
Okay.
I go out and buy the stock for 40. I put it into your hands and you give me 50. Now, I've just bought it at 40, sold it at 50, I made $10.
Yeah.
So that's how I make $10 on that transaction minus whatever I've paid you for the right to put it into your hands. So that's how a put works. And let's take a look at some of these option values, and we'll just show if, for example, we're going to look at Cisco again. If Cisco is at 45, and in this instance it's the April 60 put, and we paid 1 11/16 for that. Cisco goes to 45, we can exercise our right to sell it at 60.
Mm-hmm.
We buy the stock for 45, we're out 45, we put it into their hands for 60. So we would net a profit on that part of the trade of 15/16. So that's where, I'm sorry, 15.
Right.
We would net a profit of 15 on that part of the trade, minus any price that we paid, which was the 1 11/16. Stock is at 50. We can buy the stock at 50, put it into the seller's hands for 60, and then we've made 10 on that part of the transaction. If the stock is at 80, we are not going to buy the stock at 80 only to sell it at 60.
No.
So at 80, the option is worthless.
Mm-hmm.
So that's how puts are valued. And again, the stock was 64 and 15/16.
Right.
At $60, if the stock were to have stood still, the option would be worthless, and that means it's out of the money.
Mm-hmm. That's right.
And here's a graph of the value, and you can see we're making dollar for dollar as the stock declines below our strike price
Mm-hmm.
of $60.